Welcome to TradeTheMBI.com. This is John. This report is for the 9th. Well, a little continuation. There's just the positive elements. Of course, late in the day, you ended up with the news of Trump supposedly meeting North Korean leader May. It's just part of the theater. A lot of this stuff is just a distraction. At the end of the day, we just have to look at the fundamentals of, economic growth and where things are. And you now have J.P. Morgan claiming a 40% correction coming. And how many years have we been listening to that tale of how everything was going to go to hell in a handbasket? We went from no growth to serious growth. The new tariff deal that's been signed obviously allows people with exemptions. And of course, that means you can get an exemption if you're not violating fair trade practices. It's common sense, but never been applied before because of this specter that, it might actually increase costs for, cheap products. Well, at a certain point, some of those cheap products are too cheap and they undermine domestic capabilities, and so this is sort of that fight back, and it's not a bad thing, but it is inflationary. So it's going to impact gold, interest rates, those kinds of things, and a return to normalcy. A lot of people after a decade who weren't part of it don't even remember what it was like to be in a real free market since the collapse. And again, there's just that question of all that liquidity that's been thrown in, how quickly it can be absorbed and or how slowly it can be absorbed so that it doesn't create a massive disruption. You can see the NASDAQ clearly way ahead of the S&P again. That's going to have to normalize. It could take a little while, but definitely has to be brought back into order. Fade back in the euro just a little bit, and this is a little out of control anyway. And again, we're outside that range that was agreed to, which was below 120. So there's still going to be some fill back, but that's definitely supported the S&P in a broad manner. And of course, treasuries still higher than they should be, and sort of in a holding pattern because, again, you have a large group that's still wanting to put their money into safety. But as rates rise there, we should expect that to move lower. Oil, right down back at the bases. There's been nothing of significant strength here. You can see we continue to have this being a weak pattern along with the orange cut between cyan and red. And that usually is a continuation, which is slightly lower in this modification. It's not oversold or anything like that. But that actually helps from the inflationary standpoint because it's not putting that upward pressure. We saw this big move here was the pre-build-up of it. When it faded back and we came back so quickly, you're never going to see this reduction impact unless we pull right back down here. And even that's not going to take place until the second half of the year. And gold, not responding. And again, we talked about this, and why gold isn't much higher is certainly related to the derivatives of gold certificates and that, as opposed to the actual free trading of the metal itself. So it definitely has kept it subdued, but there will be a breakout point. So here's the 5K chart. It's pretty clean. We have the big rise that took place earlier in the previous day, and look at how tiny the range was. I mean, there's just no activity whatsoever in yesterday's move. It was just all pretty quiet because there wasn't anything to drive volatility in that. This move has been made. We've got to absorb it a little bit. This is what they call that melt up. And again, this just parallels exactly what I've been talking about. So from the early 90s, when we first had resurgence of growth, when the Republicans had balanced the budget and things started to transition to really healthy financial status for America. Now, we're not quite in that same thing because of the deficit range. However, the deficit is much smaller, if not for the interest rate increase. Would have been a net zero, which is shocking. Now, of course, the tax cut we're still yet to see. There should be a modest blow-up size. Of course, they're still smaller than what Obama was spending during his time, but the question will be, will revenues of the extra repatriation of money as well as increased economic activity make up for that reduced tax rate? And that remains to be seen yet. We won't know for a couple of quarters on that one. But you can see it was relatively modest day. I mean, it was just pretty much a flat line going across and mostly just little bullish orange dips here each time we came down. And all it was, moved to the top, rising lows, called for a 50% retrace, exactly what happened. And then when the rising lows took place, we were making new highs. So as long as the new highs are being made, you don't have that pullback yet. And likewise, so now we're going to need to see a new high, or we're likely to come right back. But now the 50% is getting very close to what the previous highs were. And that's how that works. So all in all, pretty clean stuff that I would show this one. This is that Bitcoin. And you just had a couple of serious announcements for cryptocurrencies, where first it was, oh yeah, the IRS is going to, get involved and start monitoring everybody in America, at least who's been making trades off of it. We had that algo move that was back from here. Well, I went too far there. Increase that again. We don't need to be that deep into it. But it was that initial algo move that caused the push up right here, which was positive extreme related right there. And we shot up, but it was set for that return. And here's an easy way to see it here. You can see the steel all the way up here. No resets other than the breaks that skyrocketed before, but they really don't have any staying power when it does that. And you can see it in a broad sense whenever you have these points with the steel up there versus the steel down below. You have the rising points, even with the little retraces. It's predominantly bullish, and then you have the predominantly bearish, and it's really a good way to look at it, even though this is a time chart. So we broke those lows because, again, we couldn't get any steel in it, reset, and every time you did end up with a dip down, you created a little spider to the short side, and that was the last time we were at the 50% right here. Just broke it down. And it's been a significant move. So you can see right here where the the cyan meets the green, which the midterm buyers being overwhelmed by shorts real quick, as well as the short-term buyers then dipping below cyan, and that was the breakdown that led to the new lows. And while you ended up with a slightly bullish move right there, came right back down immediately, and again, shorts activated strong under that situation. And here we are down at the lows. We had the first opportunity here with that break above the plus 13, which took place right on that MBI signal, and then you had the orange dip below, so a little bit more of a push, but again, no reset. Now, this is still within a modestly bullish configuration within a bigger short, and until that steel breaks below the cyan, you're still in that positive run, but it's still not producing anything. And this is part of the little push of governments into cryptocurrencies. There's not going to be any free ride from people from both. And then you have the court ruling, obviously, too, that took place the other day that said that to be treated like securities. And so what people thought was an independent thing isn't going to be so independent anymore. Anyway, broader spectrum, we're still looking at the general bullish tint, and just put the daily back up there. It's not anything significant. We're not looking for massive move at this particular point because we never got a steel reset. So short-term buyers kind of used a lot of it. And we saw that, they had the report of the retail investor having pulled out during this whole dip move and that. And the reality is what's going to happen is the market's going to come back up here, and then retail is going to realize, oh my gosh, I got to get back in again. And that will be the concern point for, I would expect, real selling to take place, because you need those new sheep to come in and buy so that you can unload into them. This is how the market works in inverse of what people expect. And we know that, and we'll keep an eye out for it. And I'll continue to post relevant charts as necessary. There just wasn't anything happening the other day, so wasn't anything to do. So it should be a soft end to the week. I would look for late Friday buyers to potentially pull us back for the ES back up in towards that. I don't know if we'll get quite up into the 2780 range in one day or whatever, but it's just going to be a slow move back and forth here. It's still weak shakeout, so things haven't completely turned around. So we just kind of go with what is, and it looks to me like it's more in between scalp trades as opposed to the longer trend at this particular point, though the bias still has to be the upside with the economy moving in the right direction. As always, though, trade well, and we'll talk on Skype chat.